In Chapter 5, we'll start looking at consumer credit, the advantages, disadvantages, the sources, and cost. The thing to keep in mind is that credit is very important. And people say, oh, you shouldn't have credit cards, you shouldn't, that's not realistic for most people. And it's not to say that people should live on credit, meaning you shouldn't drive yourself deeper into holes because of credit, but credit has a use. It's a way, again, back to our life cycle hypothesis. It's a way for us in our younger years to be able to consume beyond our income, and this is so there definitely are positives, and we'll get into the advantages, etc. So quickly analyze advantages and disadvantages of using consumer credit. We're looking at this in personal basis, of course. Assess the types and sources of consumer credit, determine whether you can afford a loan and how to apply for such credit for those loans, right? Determine the cost of credit by calculating interest using various interest formulas. Develop a plan to protect your credit and manage your debts going forward, right? So first thing, analyze the advantages and disadvantages. Credit is an arrangement to receive cash or goods or services now and pay for them in the future. So consume now and pay later, right? Sounds like a terrible thing, but it's a necessary thing, and it's not so terrible. It makes absolute sense. If you're going to raise a family, families are expensive, and it's very difficult to raise a family with just straightforward income. So you can't. It's hard enough to buy cars and homes, let alone if you didn't have access to credit. For many people, for most people, most normal people, that would make it an impossible situation for you to get through. Anyway, based on trust in people's ability and willingness to pay bills when due. So you sign up for something, you agree to something, and you follow through on it. Consumer credit, use of credit by individuals for personal needs except a home mortgage. Okay, that's a different category because it's such a huge portion. Again, with emphasis here, a major force in our economy. It drives consumer spending. Consumer spending is the largest portion of spending in the economy. The most important portion of our economy has to do with what are called personal consumption expenditures, and that amounts to at least 60%, maybe closer to 70% of all spending is coming from the consumer side. So it's that important for the economy to be operating smoothly, if you will, efficiently. Uses and misuse of credit. Before you use a credit for major purchase, consider, do I have the cash for the down payment? Do I want to use my savings for this purchase? Does the purchase fit my budget? You have to do all these things, these sanity checks. Opportunity cost. Oh, here it is. What are the opportunity costs of postponing this purchase? My car is broken down, and it's a total mess. The engine failed completely, and I cannot. It's beyond economic repair, and it's the middle of the winter in Michigan. So what are my choices? Very limited. So you have to purchase. So the opportunity cost of not buying that car to get to work 20 miles away are such that you've got no choice but to go out there and make that purchase. All these things kind of come into play. What are the dollar and psychological cost of using credit for this purchase? Buyer's remorse. If you make this purchase, remember that purchase is going to haunt you until it's actually paid off, whatever that is. So these are all things to kind of keep in mind. The advantages of credit: current use of goods and services, again, consuming now and then paying for it over time. Permits purchase even when the funds are low, cushion for financial emergencies, advance notice of sales, easier to return merchandise, convenient when shopping, and provides a record of expenses. These are all things that are very, very straightforward. Advantages of credit: one monthly payment, safer than carrying cash. Needs for hotel reservations, car rentals, and shopping online. Take advantage of float time, grace period before you make a charge, and your payment without paying any interest on that typically is about a month, or is close to a month. No more than a month, but close to a month. Rebates, airline miles, other bonuses, like American Express cards and so on and so forth. Credit indicates financial stability. It's something that if you are to establish your credit worthiness, you have to have what? You have to have credit. The history of it. Disadvantages, temptation to overspend. It's a credit card. Yes, I have a limit of $10,000 or $5,000, and we all know the story. It's just because there's a limit doesn't mean you spend it, because you do have to pay it back. Can create long-term financial problems and slow progress toward your financial goals. Absolutely. Potential loss of merchandise due to later non-payment, repossession time. Ties up future income, so you spend now, you won't be able to spend tomorrow, is the point. Credit costs money, more costly than paying with cash. Otherwise, what's the point, right? What's the benefit for the person who's lending you the money, so to speak, the credit card companies? So again, all this stuff is very straightforward. Assess the types of sources of consumer credit. Two basic types of consumer credit: closed-end credit, open-ended credit, one-time loans for a specific purpose and a specific amount paid back in a specific period of time. Car loan, right? You're borrowing $10,000 to purchase a car, and you pay that back over in equal payments over the course of the next 2 or 3 years, etc. Open-ended credit, use as needed until line of credit is reached. This is also called it's rolling credit, if you will. I forget the term. Anyway, it's as if the author puts it, it's open-ended credit. Okay, variable credit. These are credit cards where you're spending more one month and paying some off, and spending a little less the next month and buying down your balance or having a zero balance, etc. That's the open-ended credit. Closed-end credit, one-time loans for specific purposes. Again, installments, installment credit, installment cash credit, single lump sum credit, all these things that go into this. Mortgage, automobile, furniture, appliance, electronics. Volume of consumer credit has exploded over the years, and it's even, of course, much higher now. So back in 2014, we were looking at over $3 trillion worth of consumer credit that was out there. Okay, at any rate, open-ended credit used as needed until line of credit max is reached. Again, this is credit card. This is revolving. That was the expression I was looking for. Revolving credit accounts, where your the balance varies, or you may have zero balance, but the point again is that it varies from month to month and you have access to it. Credit cards, department store credit cards, home equity loans. If you don't pay it, then you have to pay the interest, in full. You have to pay the interest on that. Credit card, average card holder has more than 9 credit cards. Convenience user versus borrowers. Finance charge equals the total amount paid to use a credit card. Teaser rates, of course, are, well, you get this, same thing happened with mortgages. You can get this teaser rate for 1.9% for 6 months, and then after that 6 months, it goes up to 25% on the balances that are outstanding. Reward programs that are out there. That's again, American Express. Others have rewards for frequent flyers, for example. Credit-like cards, debit cards are similar, of course, in the way that they function, but that's money that you pull directly out of your checking account. Stored value cards, which are gift cards or prepaid credit cards. They're not credit cards, but they act like credit cards, as they say. Credit-like cards. Credit-like cards. Others are smart cards. Anyhow, smart cards, travel entertainment cards, Diners Club, American Express, you don't pay for services at the time you purchase them. There's slightly difference. Balances is due in full each month. Even though American Express has changed significantly, that was the general idea. And also you can pay on your smartphone now. Sources of consumer credit are loans, borrowing money with agreement to repay with a certain amount of time. Inexpensive loans are, except for the other side, parents or family members. Medium price loans, commercial banks, savings loans, credit unions, etc. Expensive would be finance agencies, household finance, check cashing companies. retailers such as car or appliance dealers, bank credit cards, and cash advances. Very expensive loans. Higher interest rates is really what it comes down to. Sources of consumer credit: home equity loans, loan based on your home equity, the value of your home, current market value of your home minus the amount you still owe on the mortgage. So, for example, you have a home that's worth $100,000, and you paid off half of the home, so you've got $50,000 of equity in the home, value in the home that's yours. You could presumably borrow that $50,000 back from the credit card, from the mortgage company in the form of that home equity loan. So you could borrow 100%, for example, for home equity loans. It's not uncommon, not exactly advisable, but at least, again, it's a good avenue because the interest is tax deductible. And again, it says here, it should only be used for major purchases. If you want to buy a car and you want to pay cash for it, for example, and it makes sense to pay cash for it, this is one way in which you could do that. Suppose you owe a home worth $200,000. Your mortgage balance is $125,000. How much can you borrow? You can using home equity, if your lender will allow you up to 80% value, 80% of $200,000 is $160,000. So you can borrow up to $160,000 minus $125,000 gets us to $35,000 using that home equity. So this is a listing of consumer credit that's available, and they are all over the place. People always are trying to lend money. Sources of consumer credit: commercial banks, finance companies, credit unions, life insurance companies. People don't think about it, but it's true. Federal savings banks, savings and loan associations, etc. Learning objective 3: determine whether you can afford a loan and how to apply for credit. Before you take out a loan, ask yourself, can you meet all of your essential expenses and still afford the monthly payments? These are all just sanity checks, just to start with. You have to be realistic about these things. What do you plan to give up in order to make the payment? You have to consider these things. Are you going to reduce the amount that you're saving? So on and so forth, whatever. So the general rules of credit: capacity, the debt payments to income ratio, monthly debt payments divided by your monthly income. Consumer credit payments should not exceed 20% of your net income. That's just in general, okay? It's not including house payment, which is a long-term liability. And that's another consideration, but this has more to do with that revolving credit or going out and buying a car or something like that on credit. General rules of credit: capacity, debt to equity ratio, total liabilities divided by your net worth should be less than 1. And again, excluding your home value. Hopefully it's less than 1. Anyway, so in other words, total liabilities would be less than your net worth, right? Example, calculating credit capacity ratio. So Sam's monthly debt payments, not including his mortgage, are $825. His monthly income is $2,425. Total liabilities is $9,400, and his net worth, not including his home, is $24,750. Calculate Sam's debt payments to income ratio and his debt to equity ratio. So back on the first one, Sam's debt payments to income ratio, monthly debt payments, $825 divided by monthly net income of $2425 gets us to 34%. Sam's debt to equity ratio, Sam's total liabilities, $9,400, and his net worth is at $24,750. Again, that gets us to that 38%. Okay. The 5 C's of credit, something to keep in mind always. Character: will you repay the loan? Regardless of how difficult it is, will you repay the loan? The capacity: can you repay the loan? Capital: what are your assets and your net worth? What do you have to back this up? And speaking of backing up, the collateral: what if you don't repay the loan? Conditions: what if your job is insecure? This is the reality: is that jobs are insecure. We live in the gig economy, right? Gig meaning you're moving from one job to another constantly. You've got more than one job. You've got 1, 2, 3, 4, 5 jobs in some word cases. You've got multiple jobs. Anyway, your credit report, it's on file through credit bureaus, Experian, TransUnion, Equifax. Typically, I think now most of this has gone through, I forget, Equifax or Experian. Credit files, again, they contain your credit details, your credit history. This is kind of lays it out there, and they're not always correct, so you've got to really be wary of that, aware of it, I should say. So, Fair Credit Reporting Act from 1971 requires out-of-date information be deleted, but you've got to tell them. Give consumers access and ability to correct that misinformation, which again, you have to do. Place limits on who can obtain your credit report. So who can obtain your credit report? Only authorized persons have access to your report for approved legitimate business purposes. Time limits on unfavorable data. Adverse data can be reported for 7 years. Bankruptcy can report it for 10 years. Exception, application for credit greater than $75,000. Application for life insurance of greater than $150,000. Incorrect information in your file. You may request a copy of your credit information within 60 days of being denied credit. So you find out why it is that and you may also request a free copy of your credit report annually. What are your legal rights? You have the legal right to sue the credit bureau or the creditor that has caused you harm. In other words, the takeaway from this is that if you have a bad credit report, whether it's your fault or not, you should find out exactly what's going on, what your credit rating is, and go from there. And if it's something that has to be remedied in terms of making corrections, and you make the credit bureau aware of what those corrections have to be, then make sure they do that by following on. FICO credit score, FICO and Vantage score, FICO 350 to 850, higher score, less risk. Again, that's the general take on all of these. Is the higher the score, the better risk category or less risk that you pose to potential investors, people that want to lend you money. What is your FICO score? And the breakout is length of credit history. Payment history is the biggest portion, followed by the amounts that you currently owe, types of credit used, and new credit. The ECOA, Equal Credit Opportunity Act, gives all applicants the same rights. Credit providers may not discriminate based on race, nationality, prohibits redlining. And we could talk about that, but we'll pass on at the moment. But so redlining, age, Social Security, or public assistance, sex, marital status. So basically what we're saying is that they're looking at, when you're applying for credit, they're looking at you as for your credit, not as you as a person, but what your credit status is, right? That's really what it comes down to. If you're denied credit, you have the right to know the reasons, risk-based pricing, charge higher rates to riskier customers. Effective lenders must disclose details if risk-based pricing is being used. Customers not receiving the best rate must be advised of their credit score. If you are denied credit, there are tons of avenues by which you can follow to get clarification, so on and so forth, and it's something that you should walk through the process if in fact you are denied credit or if there's some problem with your credit history. There are avenues to follow. What can you do to improve your credit score? Again, start with getting a copy of your credit report, verifying the information, pay your bills on time, always the case. Character, right? Out of the 5 C's, character, pay your bills on time. Understand how your credit score is determined, learn the legal steps to take to improve your credit report. Be aware of credit repair scams, okay? Learn the legal steps to improve your credit report. This is imperative. How is your credit score determined? Do you pay your bills on time? What is your outstanding debt? How long is your credit history? Have you applied for new credit recently? How many and what types of credit accounts do you have? All of these things are if you were lending money, these are all things that you would be concerned with. Does this person I'm lending pay their bills on time? What is their overall debt? Are they actually able to afford to repay me? These things are just common sense, right? Of course, there are things that There's some downside to all these things, but this is in general, the general idea that we're looking at. Determine the cost of credit by calculating interest using various interest formulas. The finance charge, the total amount you pay to use credit includes interest, cost, and fees such as service charges, credit-related insurance premiums, or appraisal fees, which drives us through this, what we call the APR, or the annual percentage rate. The percentage cost of credit on a yearly basis. So this is the overall cost when you fold in the fees and so on and so forth. So there may be a stated rate of 5%, but you find out with the APR, because of all the fees that are thrown in on top of this, that the actual rate is some number higher, meaning not 5% or 4%, but 6% or 7%. So this is, again, caveat emptor, the buyer beware. It is important to shop for credit. Example in calculating APR. Borrowing $400 for 3 years, making monthly payments, or total finance charge for the entire period is $54. Approximate her APR. Straightforward. 2 times M times the interest times the okay, so 2 times 12, 12 being the period, and 54 being the entire interest, rather, over that period of time, divided by the what she's borrowing in the first place, the $400, divided by the number of periods within the 36 over 3 years, 36 months over 3 years plus 1. Okay, it brings us back to 8.76% APR. It's very important to walk through this and to figure out your APR. This is your effective rate of interest that you're actually paying. It may be, she may have been sold on something where she was paying, where they were saying that your interest rate is 7%. But when you fold in the finance charges, it kicks us up to 8.76%. Anyway, tackling the trade-offs: term, length of loan versus interest cost, lender risks versus interest rate. To reduce the lender's risk and thus the interest rate, you can accept a variable interest rate. That means variable meaning how it's affected by what? Inflation. Because there's inflation, there's a risk of inflation with any kind of a financial instrument, specifically or especially with a loan. If you have a loan for a 5-10-year loan, and inflation hits, it's going to reduce the value of that, of those payments, and it's going to reduce your real interest rate return, your real rate of return. Anyhow, accept variable interest rate, provide collateral to secure a loan. So you have a secured loan, meaning that if you don't pay off the loan for your car, then you will have to surrender your other car that's worth more, for example. Provide upfront cash. This is kind of, think about leases and so on and so forth, where you're leasing something and you pay a certain amount up front as a deposit, if you will. Take a shorter term loan. Just different ways of doing it, because again, shorter term loan, time value money, shorter the time frame, the lower the interest rate. Calculating the cost of credit: simple interest, compute on principal only without compounding. The dollar cost of borrowing interest is equal to principal times rate times time. Very straightforward. Simple interest on the declining balance. Interest is paid only on the amount of original principal not yet repaid. Add-on interest calculated on the full amount of principal interest added to the original principal payment equals the total divided by the number of payments to be made. So this is another, it's called add-on interest. So for example, calculating the cost of credit: Scott needs to borrow $6,000. His choice of 3 loans. The first loan is 6% simple interest with 1 repayment at the end of 3 years. The second charges 6% simple interest on the declining balance with annual payments. The third loan is an add-on 6% simple interest loan, also with annual payments over 3 years. Calculate the APR for each loan. So walking through this, again, payment 1 for the simple interest, we're walking through zero payment for 0 payment 2 for loan 1, walking through your APR it turns out to be 5.99%, paid over that period of time. And whereas with the loan 2, interest on declining balance, simple interest on declining balance, you end up with paying slightly higher, pretty much the same, but slightly higher. Whereas with the add-on interest, where you're kind of prepaying, if you will, the interest, you end up paying significantly more. So these are all things to be, to consider, to be cautious of. Example, in calculating the cost of credit, calculation total interest is $6,000. So the loan is $6,000 and you're paying 6% over 3 years. So 6% times 3 is, or 6,000 times 6% times 3 is $1,080. R is equal, and then we walk through and we end up driving us back to our APR at 5.99. Loan 2, same idea, and it's worthwhile. I'm not going to do this here, but to walk through these calculations to get your head wrapped around the concept of the APR, annual percentage rate, because depending upon the structure of the loan itself, the interest, how it's being paid, whether it's simple interest or some other way of doing this, it could definitely impact your APR, your annual percentage rate. Okay, so calculating the cost of credit, cost of open-ended credit. Truth in Lending Act requires that open-ended creditors inform consumers how the finance charge and APR will affect their cost. You have to know this. You have to be apprised of this, given notification on this. Cost of credit and expected inflation. Incorporate the expected rate of inflation when deciding how much interest to charge. Avoid minimum payment trap. The longer you take to pay out the bill, the more interest you pay. And they walk all these through on credit card statements. If you've ever seen one where they say, if you pay this off in 3 years' time, then if you pay this off in 5 years' time, how much more you end up paying over a period of 5 years. So anyway, develop a plan to protect your credit and manage your debts going forward. Notify creditor of error in writing within 60 days. Pay the portion of the bill not in dispute. Creditor must respond within 30 days. Credit card company has 2 billing periods, but no longer than 90 days to correct your account or to tell you why they think that the bill is correct. So these are all things that have to be walked through. Fair Credit Billing Act, 1975. So these are pretty dated, so they've been around quite a while. There have been a lot of credit protections out there for consumers, and even though there was more with the CFPB, Consumer Financial, anyway, there was something that was done within the last 10 years where it was also as in response to the mortgage market collapse in 2008. At any rate, Fair Credit Billing Act 1975, disputed items won't affect your credit rating while in dispute. They can withhold payment on damaged or shoddy goods or poor service if purchased with a credit card. Added bonus of using a credit card. Must make sincere attempt to resolve problem with your creditor. So you've got to come to the table. What to do if your identity is stolen? Contact the 3 major credit bureaus. Ask the fraud departments therein to institute a fraud alert. Request your creditors call you for permission before opening any new accounts in your name. Contact your creditors. Check with any accounts that have been, and file a police report. Keep a copy. This is important, keeping a copy. Protect your credit from theft or loss. Shred any papers that contain PII, personal information. Personally identifiable information, PII. This here is personal information. Close your accounts immediately. Be sure your credit card is returned after a purchase. Keep record of credit card numbers. Notify your credit card company immediately if your card is lost or stolen. Protecting your credit information on the internet. Use a secure browser. Keep records of online transactions. Review monthly bank, credit card. All these things that are they're just precautions that, never give your password out to anyone. These are all things that are pretty standard, but we do have to pay attention to them. Co-signing a loan. Careful with this one. Co-signing means guaranteeing the debt. So if you co-sign a loan with a child or with someone else, If that person does not pay the loan, then you are on the hook for it, okay? Complaining about consumer credit, first try to solve the problem directly. And there are paths that you can take, variety of consumer credit protection laws, federal agencies, truth in lending. This is laws, there are laws aplenty out there, and there have been more since this time as well. These are a word to the wise, managing your debts. I'm sorry I'm flashing through this, but these are all things that you can review on your own, slow things down and read through them. But warning sign of debt promise, paying only minimum balance each month, trouble even paying the minimum balance, total balance increases, so you're going the wrong way. Missing loan payments or paying late, using savings to pay for necessities. It goes on and on, exceeding the credit limits on your credit cards. These are all things that when you get into these situations, it's very painful, and it's a difficult place to be. But keep in mind that if you sit down and look at your situation, where it's at, where you're at that given point in time, you have to figure out where you're at before you can address it. And the absolute strain that comes from these, when you're in financial turmoil, the way that you can get rid of it is by being honest and being straightforward as possible with yourself. Managing your debts, debt collection practices. The FTC, the Federal Trade Commission, enforces the Fair Debt Collection Practices. FDCPA prohibits certain practices by debt collectors. Their debt collectors are notorious for doing things that are off the books. They do things that are way beyond the pale, way beyond where they ought to be operating, but does not eliminate legitimate debts. If you have a debt that you can't pay, there are different paths you can go, including bankruptcy. But financial counseling services, CCC, consumer credit counseling services, look for the nonprofits. Nonprofits supported by contribution from banks, merchants, etc., provides education about credit, very important things. They can help you with debt consolidation to repair your credit history so that you can go out and do those things that you want to do. Other counseling services, university, local, county extensions, there are numerous. But again, be very, very wary. Check with your financial institution or consumer protection office for a list of reputable, low-cost financial counseling services. Very important. You'd be surprised the number of people that really, really need these services. And ultimately, when we're talking about insolvency, when you can't pay your debts, or if your debts are so high that there's nothing you can do about it. It's whether we're talking about insolvency or if you're illiquid, meaning again, if you can't cover your short-term debt versus long-term debt. This is where you go through the bankruptcy process. Chapter 7 is a straight bankruptcy, and Chapter 13 is a wage earner plan, is where you sit down and go through a plan of how you can repay some of your debt, portions of your debt. Straight bankruptcy, Chapter 7 is going through and wiping out your debt altogether, which is it's in one way it is more desirable, but another way it's not, because it's not in terms of that's on your record for quite some time. We'll leave it at that, 7 to 10 years. U.S. consumer bankruptcy filings had gone way up, and then they had fallen back down. There are reasons why they go up and down, not just because due to economic environment. They also has to do with the bankruptcy laws that are put into place. At any rate, things were getting out of hand, obviously. And remember, we're talking about a population of how many? We're talking about a population of 330 million people, and 10, 15 years ago it was 300 million people or less. And we had in that time frame consumer filings of bankruptcies to the tune of how many? 2 million per year. I guess I'm looking at the numbers, but they're enormous, the number of bankruptcies that were out there. So it's not uncommon. It's still very, very painful, and it's something that impacts you for a very long time. Chapter 7 bankruptcy, you can keep some of your assets, everything's wiped out, you keep some of your assets, home, vehicle, intended again as a fresh start. Most personal filings are Chapter 7. After Chapter 7, you may no longer owe retail store charges, bank credit charges, unsecured loans, hospital, physician's bills. You may still own certain taxes, fines, child support and alimony, education loans. So you're taking out loans for school. Your student loans are still, you're still in the hook for them. Debts from willful or malicious acts, in other words, where you were some fraud was involved. Makes it more difficult for consumers to file. This was the act in 2005, and which forces you into Chapter 13 repayment plan. Debtors must wait 8 years from their last bankruptcy to file again. So the limitations are out there. And it, as it says, clamp down on bankruptcy mills, etc. Chapter 13, debtor with regular income proposes a plan to eliminate debts over time. So this is restructuring your debt is basically what it is. So Chapter 7 is, that's wipes out your debts entirely. Chapter 13 restructures your debt. And again, this could be something to last up to 5 years. Effects of bankruptcy, of course, are creditors may consider the inability to file bankruptcy again for 8 years. The point being is that it's out there. It's marked in your credit report for a period of time. It's not something that you do lightly. Okay. So again, walking through the summarizing this, I'll leave it at that. And one thing to note here. Remember the 5 C's: character, capacity, capital, collateral, and conditions. Character, repay your debt. Capacity, what is your ability to take on this debt in the first place? What is your capital? What is your again, back to your ability to pay that debt? What kind of money do you have to, if you're earning $500 a month, how can you take on a $50,000 debt that has to be repaid over 5 years? It's not going to happen. You don't have enough capital. You don't have the capacity. You don't have the collateral to a secured debt versus unsecured debt. You have something to back it up, something to offer, and lastly, conditions. So anyhow, again, the APR is something very important. In all loans that are out there, they have to have the APR. What the effect, not just the stated rate of your loan, whatever that interest is, but also everything else folded in. So you may have a loan for 3%, 4%, but the APR gets it up to 5% because of all the fees and so on and so forth that are tacked on. Always review your credit report. If there's a problem with your credit report, you can contact the credit reporting agency to rectify the problem, or at least to hammer out the details and how to go about repairing that. And there are a lot of laws out there protecting the consumer, obviously.